Hey, good morning, everyone. Welcome, and thank you for taking the time to dial in live. I've got a lot of material to cover here, so I'm just going to jump right into it. We're going to look at a lot of charts and try to get into some granularity so we're clear about what it is that we are, what we're thinking and what we're looking at. So lots and lots of fundamental news, fundamental information in the news this week. And it's all starting to come out. You've got OPEC having conversations. We've got issues and conversations coming with Mexico relating to trade. We've got issues relating to the Federal Reserve, and what they're going to do with interest rates in minutes. And we've just got an onslaught of information coming our way. And so what that tends to do is overwhelm our senses and make us like bipolar, right? We get pulled one way, we get pulled the other way, and it makes it extremely difficult to keep a level head and stay with a market, because there are compelling reasons to push these markets far higher, and there are compelling reasons to drop them like a rock. And so, which is it, and what side of the boat do we want to be on as farmers? And you've heard me talk a lot about in recent weeks, just trying to make it simple and trying to let price be our guide, and that is 100% correct in what we want to do. And one of the tools that we use to do that are Elliott waves. We don't talk about them a lot, but the basic theory between Elliott waves is that markets tend to move in observable and repeatable patterns. And I don't want to get too far off into the woods in the psychology there, but the fact is that when you look back at a history on a chart, you can see the moves unfold as they move. So now, Elliott waves are not our primary trading system, but they are a tool that's useful, and I think it's helpful to understand where the Elliotticians believe that we currently are, and that puts some clarity around why we're trading to where we're trading, because they're extremely widely used. And with any technical indicator, the more widely adopted it is among technicians and traders and fund managers, the more power they have over the market, okay? So it's important to understand what they think, even if you aren't necessarily going to be trading with them. So our Elliott wave indicator isn't an exact Elliott wave indicator because you really can't fully automate it. There's too much judgment, there's too much individual bias that goes into them. But the one we use was written by Tom DeMark, and it removes all bias because it's strictly mathematically based, okay? And what it tells us constantly, you see the red numbers and you see the blue numbers. The blue numbers represent what we would consider to be a bullish wave count, and it's always presenting one. And it's also presenting what we would call a bearish wave count or a downward move. And the basic idea here is the market is always in a wave count, but we want to give some parameters as to which one it is. Now, what you'll see is you'll see a red 2 and you'll see a blue 2. You'll see some the red and the blue numbers, right? And what we have are a 1-2 sequence is always followed by a 3 sequence, and the 3 sequence is the largest price expanse in the shortest amount of time, or it covers the most distance in the shortest amount of time, and they tend to be very, very steep moves. And what you want to do is you want to avoid being the wrong direction in the wrong wave, right? Because obviously, if you're in a big up move, you don't want to be short, and if you're in a big down move, you don't want to be caught long. So what we've been trading for the last several weeks in each of our markets have been extended periods of sideways moves in wave 2 positions, and that's been across virtually all of our time frames. And so what that means is that the markets are undecided, but what's coming next is going to be very, very significant. Now, I've got Kansas City wheat up here because wheat seems to have, there's 3 different classes of wheat, right? There's Minneapolis, there's Kansas City, and there's Chicago. And they all trade independently of each other but they're highly, highly correlated. And what's really been confusing traders is the difference between the three different counts. And I'm not going to get into all of them here, but what I want to point out is that they aren't necessarily following the script. Most of the LAticians believe that we should be seeing a wave 3 move down, a wave 3 exuberance. And a wave 3 should look like this, okay? It should be virtually straight down. And what we just haven't been able to see is that move happen. And so what we're starting to find is some hints inside the wheat market that it may be about done with this down move, and that this might be a wave 2 or some other bullish wave pattern that's unfolding in the market. Now, I want to show you a couple of things that we're talking about, okay? One of the tools that that traders use is a trend channel. And we've talked about this several times, but if you snap a trend channel to a recent high and the intermediate low between them, a characteristic of wave 3 price action, or something that looks like this, is the bottom side of these trend channels. What you would be looking for is price to trade down to the line, back up, and then fail miserably and come out the bottom side of this trend line. And wheat has been unable to do that. Now, if you take it even a shorter term perspective, it's been unable to trade out the bottom of this trend channel too, which is a shorter term one. Notice we tested it yesterday, and we are right on the bottom of it. Now, supporting the thought that this market might be bottoming are traditional momentum indicators or trend indicators that measure kind of the internal strength of a market. Because if you're going to get a wave 3, what you want to see is increased selling pressure, both in terms of volume and velocity. And what we've got right here is an increase in volume. As you can see, this indicator pushes down into new lows as price accelerates. That means more traders are jumping on the bandwagon. They're getting shorter as the market falls, okay? And then when you start to see lower prices coincide with higher levels on these indicators, that's a sign that a bottom is near or maybe forming. Now, what we don't have over here is a true divergence. We have some small ones, but it's not really enough to hang our hat on. But what we are missing with this down move is an increase in new selling, or an increase in volume and acceleration to the downside. And that's a warning sign that this move may be very well close to done in the wheat market. Now, why am I spending so much time on wheat? Because I know most of you care about corn. And the reason we're spending time on wheat here is because it's critical to what corn is going to do. Corn and wheat are highly, highly correlated in their competitors in the feed market, right? So in Southwest Kansas, where corn is highly used in feed rations because we have so many cattle on feed, and corn is absolutely scarce in Southwest Kansas because there was a total disaster in the Western Kansas corn crop. It's in a massive deficit, and feeders and end users are scrambling to get bushels from somewhere else. If wheat gets too much cheaper here, it starts to put itself into the feed ration, which is supportive both to corn and it's actually bearish corn, but it extends the life. So what you're starting to see is weakness in the corn market tied to wheat. Okay. So this makes sense. If the feeders don't need the same amount of food, and they can't afford corn because wheat is too cheap, they start buying it. That decreases the corn price, but it increases the wheat price. And then once that level gets back to a point where corn is cheaper and a better feed alternative, then corn snaps right back up. Okay, so a bottom in wheat leads to price expansion in corn. So now let me move over here to corn, and let's look at what we're dealing with. You'll see the red 2 and the blue 2 immediately. This should just jump out at you on the screen. Okay, corn has been tracing this sideways move. We've been talking about this literally for months. Is Is the corn market digesting this move down from the summer in this upward sideways move in a wave 2? Or is corn digesting this upward move from the July low into a sideways consolidation into a blue wave 2? Which count will win? And we still don't know. In fact, it keeps getting tighter and tighter. And for the last 10 days, we have been trapped inside the range from November 15th. We have not traded outside this day anywhere in here. And so I can't get excited about corn until it moves higher out of this range. And I can't get worried about corn until it moves down below it. We talked last week about the significance of this low. I don't want to rehash that in depth here because we're going to get short on time. But nothing's changed about that corn analysis. What has changed is the wheat situation. Remember, the funds are extremely short Kansas City wheat, and they're extremely short Chicago wheat. So strength in there could lead to a short covering rally, which should pop corn. And we don't know how high that might pop it. Okay, so the story is not yet done with these on the bullish side. Even though if you read Twitter and you read a lot in the media, I think people are starting to abandon the bull camp because, man, there's just not any demand, right? We're so absorbed in the headlines about inflation and recession and, oh my gosh, tech layoffs, right? That's got to be bearish corn, because if the tech people get laid off, they can't. They're not going to buy steak, and then that means the corn price is going to implode. Whatever. 2008 didn't teach us that. That's not the way it works. It actually works the opposite. People don't eat less in a recession; they tend to eat more because they're depressed. So demand for food is not going to go down just because the Federal Reserve raises interest rates, and that's worldwide. The people in China, just because they're in lockdown, doesn't mean they need less food. Anyone saying otherwise, that's a lie. That's absolutely not true, and history does not support it. So corn gets weak if we overwhelm supply and we decrease fuel. It's all about fuel in corn. So let's look at another hint on corn. Okay, I've hammered the wheat market enough. We want to wait and see what happens there, and I don't want to get overly bearish, because if we do pop higher, it could accelerate. Corn, line in the sand, hasn't changed from last week. We're looking higher. Now, I want to show you the crude oil market because it is very important to corn, right? Why is it important? Because of ethanol. It's energy, and the higher or the tighter that margin goes, the less corn demand might be there. Well, look at what oil is doing. Yes, it's been getting imploded, but it is starting to rebound. And so strength in the energy market is strength in the corn market. And they have not been trading with as high of a correlation as they probably should be and as they have historically. But at some point, that correlation will most likely re-engage, and we'll go back to recognizing that, oh man, corn demand is really good. Now, let's also talk about what this means for soybeans. And then I want to turn our attention to next year and talk about acreage, because energy is a big, big deal. And we have a huge push towards increasing renewable usage, not decreasing it. So ethanol is preferred, even though the media would say that maybe it's not. Ethanol is preferred because of incentives. The other thing that's preferred because of incentives is biodiesel. Biodiesel is a really big deal, and it's being used in a higher and higher level in aviation fuel, which is being seen in soybean strength. Okay, now let's look at soybeans. Soybeans, same thing. You've got a B and a 2. This is really honestly a bearish count. Okay, this is not a bullish count here at all in beans. But what's starting to change is that this count is coming under pressure, and further strength in beans is going to relocate these numbers over here and start to put pressure on these upper levels. Okay, so these things are never set in stone. They can always be adjusted over. Now, beans have been digesting bearish information for a really long time, and that information is starting to manifest itself in the news. What is it? Well, it's a huge crop from South America. It's bad exports. Oh my gosh, China doesn't like us. Their people aren't going to eat. They're going to let their pigs starve because of COVID. Blah blah blah. Whatever. You know, that's just nonsense. The Chinese people are not going to starve to death, and President Xi is not going to let that happen because they will revolt and there will be a revolution. They will not let that happen with 1.5 billion people that they have to feed. So what does it mean for soybeans? Well, all the bearish information that's now manifesting itself has been being traded for a long time. That's why we use charts, because the fundamentals, the lack of demand, the excess of demand, whatever it is known by the parties that are entering the deals far before you and I hear about it. And that their action that they take to secure their economic status is manifested right here in our price action. So something is going on in the soybean market, because this move higher is a significant move. It's happening on increased volume, not decreased. It's happening without the knowledge of existing fundamentals, and we just don't know exactly what's going to manifest itself. And I would guess that we're going to be up in here before we figure out why that happens. Okay. Now, remember also is that in technical analysis, the most bullish moves are usually about a third done when the public finds out about why they're moving. The beginning of a move starts with pessimism. And it starts with people saying, oh my gosh, no, it's just a counter trend rally, whatever. And then the news hits and we realize why, and then people are late to the game and they push it higher. And then people are even later to the game, the really small specs, and they say, oh my gosh, right? So they begin on pessimism, they mature on optimism, and they die on exuberance, okay? So when people lose their minds about soybeans, that's when you're going to want to look to start selling them. Now, where are we in this move? We're in the pessimism stage. And it's definitely not out of the woods. I mean, if we reverse and come back down below here, certainly below Monday's low, then the bullish narrative is done, and I think we're going to head lower. But as long as we're above this 1420 level on January beans, I think we got to look higher because of this action and the way it's unfolded in here. Okay. Now, last thing that we really want to talk about is the dollar, because the dollar is key. And if you read the news, you know, it's all about the dollar. Will it go up? Will it go down? Because surely a downward move in the dollar's got to be bullish grains, and an upward move in the dollar's got to be bearish grains, right? Well, over time, yes, that is generally true, but in the short term stuff, not necessarily, because they can be disconnected for a little while. So what are we looking at here? Well, remember our wave analysis, okay? You've got a 2 and you've got a 3. You've got zeros forming down in here. So you got to assume that as of now, this wave count is starting to look bearish. Is it also meeting our other criteria that we're in a wave, in a declining wave? Well, yeah, right there. See how this, you snap from one intermediate high to the next, and then the intermediate low, you put the bottom of the trend channel on, and boom, we fell right out the bottom of it. We're consolidating. I would look lower in the dollar short term. Now, we don't trade the dollar, and we're definitely not experts in the dollar. And but analysis is analysis, and you got to assume that a move of this depth is going to be followed by another low, and that we're going to come test this 104 area. And if that happens, you should see wheat pop, you should see corn pop, and you should see beans pop. All of those things are lining up to show us a little bit higher prices in the grain markets. Now, let's be really, really clear about, because I don't want everyone blinded and saying, oh my God, we got to go own it. I'm perfectly happy being sold old crop, because especially in basis. Basis is great. You know, if it goes higher, yay for us for next year, right? But there's no reason to be greedy on that basis level. If you want reownership, I think great. Reown it and be looking higher. We want to stop right here at 1424 or even up to 1449. You can even run a stop up to today's low and risk a reversal. That's just fine. All of those are valid, and it's just depending on your risk tolerance how much you want to lose. Okay, but I think we got to look up on beans, and a move back below Monday's low is going to change our mind, and we're gonna start to be real defensive. Corn, I want to be very, very clear. We are bearish below 653, and we think that I don't think that that's our preferred count. I think that the evidence is showing us opposite, but we don't want to get too excited above 677 until we can clear that 677, 680 level, and then we want to look a little bit higher. And really, this gap up in here and this price point at 690 is going to be pretty stiff resistance. So corn's got a lot of heavy lifting to do, and it's going to need wheat to explode higher in order to do it. It needs oil up and it needs wheat up in order to really push itself back up into this level, right? Why hasn't it done it already? Well, it's because wheat is down. The further wheat goes down, the weaker corn gets, because wheat's inserting itself into the corn market. I want to be really clear about that. If corn breaks lower, then we're going to finish selling old crop, and we're going to sell new crop. If corn breaks higher, then we're going to be patient and let the market do its thing and see where it takes us. Will we be lucky enough to get up here? I don't know. We'll just have to see how exuberant things get, and that's going to be tied to what oil does, what the dollar does, and what wheat does. So I know that's complicated. I know there's a lot happening, but stay with us, because simple is good. 653, above that, we're bullish. Below that, we're bearish. Can't be any simpler than that. Beans, 1428, same thing. And wheat, really, we want to see it hold this little trend channel right in here. A big down day to wheat today is probably going to kill the corn market, in my opinion. So we'll see what it does. But certainly by Friday's close, we want to see wheat up in here somewhere around 30-40 cents higher. Okay, that is 22 minutes. I know I said a lot of words today. If you guys have questions, please call. Certainly, this is our opinion, right? We don't make the market, we just follow it. And we try to make good decisions based on what the action is coming from it. If you have questions, please reach out. Remember, there is risk trading futures and options, and so you should only do so in light of your own financial condition. I hope you guys have a great Wednesday. We will talk to you next week.